Okay, what I'm going to quickly touch upon today is the effect of holding stocks through a bear market or a market bear leg, or what Sam Weinstein will call a stage 4 downtrend. Um, we're talking about, I'm talking about just having no exit plan, and I'm going to touch upon the same things come up. Every market cycle, like the good company at a good price and all that. What I want to touch upon is some of the big pitfalls here. I've been doing this since I was a teenager, and investing since I was a teenager, and the same mistakes, they just over and over again they come up. And the older you get, the less likely you want to go into that multi-year drawdown. And in stocks, especially smaller AIM stocks, but any stocks, can go the same way. It can be disastrous. So, I'll just, we'll just go back to 1930 on the Dow, and we'll just have a look at this. This is the scenario, and every market cycle, I suppose the people who scream loudest are the people who've only just got invested, and they've kind of, they're throwing out the Warren Buffett quotes, but they're trading AIM stocks. It's, you've got to learn these lessons. You've got to study why older, wiser investors, they don't do that. It's a bit, they don't take these Hail Mary sort of approaches to their investing. So, this is strikingly obvious. The short-term time frame rolls over, it bounces on a throwback, and then down it goes again, and the long-term and the short-term time frame both falling before it starts to recover. Now, this is the big red flag. Markets recover, stocks don't. So what do I mean by that? The way markets are weighted, they're weighted in, the best stocks rise to the surface, the best stocks get bigger. They weight the market. So the market recovers, it doesn't recover on the same stocks. So to think that your stocks are back at break even, say you bought here, to think your stocks are back at break even because the market is back at break even, it's just not the case. And it never will be the case because markets are weighted. So I'm just going to move on from this, and things move on. Just think about the pandemic. Zoom was the stock what was booking the trend as we went into the pandemic, and Zoom was the stock what went off on the huge run. And it fizzled out. Where is it now? Times change, they always will. Technology moves on, trends change. And the classic, what is, I know it's, you can study this in detail many times on the internet. It's the classic is the fading out of the video and Netflix basically. So let's just go back to this period in 2004 actually on the markets, and goes to find 2004. So what we had in 2004, and it's actually better, I'll show this on the S&P because it's a little bit clearer. The S&P in 2004, this is what the S&P was doing. It was grinding off this pop, and it had just gone fully bullish, the S&P, and down it came, and around this area here it went back to 52-week highs, and this is when the market came alive again. Let me just show you that on the this is the market grinding and the stocks following the market, and then this basically is what this was the effect after the market came back to highs, somewhere around here, wasn't it? Or maybe somewhere over here. Blockbusters kind of a little pop, drifted off. Netflix, it actually put a lower low in, and then off it went to highs. And so Blockbusters trading 52-week lows. Netflix started trading 52-week highs. Obviously off in its journey, and we know the result now is I think Netflix tried to merge or buy out Blockbuster. I don't know if that happened, but basically Blockbuster's delisted, didn't it, in 2010, and Netflix went on to make a huge run. So what am I getting at here? If you think the stocks now are going to be the trendy stocks in the future, it's easy to think Apple will trade forever and always be that stock, but no, it won't. At some point, it will never see its highs again. The only way a stock can sort of end on its highs is if it gets bought out, isn't it? But things fizzle out, times change, they always will, and it's always going to be new stocks what lead new market legs. It always is. Think of the stocks what were highly rated, and basically they had a following what had their heads in the sand before the pandemic, and very few of those stocks lived to fight another day in the run out of the pandemic. The big stocks out of the pandemic like CER and WATR, and those great growth stocks in the AIM market. So many good stocks had good runs, and you'll get the sort of gambling stocks move and then gold stocks move, but finding those good growth stocks, it's usually a different stock, every time. And the Gores of this world, and the Boos of this world, and Fever Trees on the great growth runs, and best of the best, in the future maybe one of those will recover and do another run like that. But you're kind of asking Mo Farah to run the London Marathon, turn around and then run it again backwards, is what I'm trying to say. It's very rare you will see that in the markets, a really significant growth run and then see it again. Now I will just highlight, I'll just have to remove this, and let's just go and have a look at Tesla. I'll put the log scale on because this little move on Tesla, I'll tell you what, I posted this in a video and people thought I was cuckoo. But, let's go back to Tesla. It made this huge run after breaking out of, 600% there, available move as we call it. And then it went to sleep for 1, 2, 3, 4, 5. Kind of getting on for 6 years, it was sleeping for 5.5 years, going sideways basically, and it actually, we put a baseline on it here, and then it drifted off, and this is a bit of a bear trap. When you see a bear trap, this is the classic, isn't it? You see this, and then you get the pro gap. What's a pro gap? It moved out of this new base range here. Bang, it went straight to highs on this huge run. This is when we put this, we just measured the prior move and said, call me crazy, but I think this could do the same again quite easily. And, what did it do? It came back in, did a base retest, because this is high probability as well when you see the reverse vol base. It's high probability because of the move it has to do. Go to the ShareScope tutorials. And the move it has to do to break out was getting on for 100% off the lows. And then it went on a good move higher. It came all the way back in. Have a look when it came in. The old base retest, pandemic. and off it went on that journey again. So, what do you expect out of Tesla now? Well, you've always got to have an open mind, but you've just got to be, this is disciple stuff, after the move. There are a lot of disciples, and, the lower it goes, the more disciples it will follow it. This is where you're going to be looking for those next leaders. You're going to be looking what's moving next. And if, coming back full circle, if your portfolio is 100% invested with all these ex-leaders, be it Boo or be it, whatever it is, they probably, some of them will bounce, but you're not going to be riding these re-rating trends, are you? It depends what your focus is. You might not want to bumble around on, single to double digit growth. If you're in the AIM markets like me, you're not targeting a feeble sort of return when the markets are good, are you? You're trying to ride some really good growth stocks and really compound those good times. So, just something to think about. The markets do not recover on the same stocks when they go into these big, all stocks will bounce, but the ones what plough higher and the ones what you'll look back at it in the future will be different stocks, and you'll say, well, why didn't I look for those stocks at the time? And the reason usually is, well, I was too busy babysitting all these ex-leaders what were, basically an anchor on the portfolio. So, I'll say it again, I don't say this to stir the hornets up. I know it always does. This is for the new investor to learn this stuff, because I'm trying to show the things what people, in my view, it's the best stuff to learn. You don't want to be on the wrong end of the curve all the time, and there's very few people who actually speak the truth in the markets. So this is the honest sort of how stocks trade. Up at the highs, everyone will be screaming and shouting about how good the company is, and then they'll be scratching their heads when it comes back to earth. You've got to be positioned for the move, not just chasing the move after the move. And sadly, the markets tend to sort of draw, a high percent of the people in after the move. So, the job is to spot what's going to move next. And the old I like growth stocks. I can find leaders just by looking at the fundamentals. It's a common thing for people to discount everything I've learnt over my 30 odd years in the markets. They discount all the fundamentals I've learnt and just call me a technical trader. If you want to ride growth stocks, you're going to learn a lot about what I call gas in the tank, what moves stocks, and something to think about. Study the growth. Do not study what Joe Blogs on financial media is telling you about this stock. Good company at a good price. You want a fantastic growth move. Good company at a good price is not going to be a reason to re-rate. Is basically, you want to try and get on board the stocks that have got a real reason to re-rate, and that's not really going to be a kind of reversion to mean value reason, is it? So there it is, my no BS sort of view on this kind of stuff. I hope it helps.